Greetings everyone, Joseph James here from theschooloftrade.com. Today was March 4th, 2010. Welcome to your live trading recap. Had a pretty good day today in the room. Took about 5 trades here. If we took all those trades we took today though, I'll remind you guys about some important links. If you're watching this video right now on the YouTube page, in the description there's going to be 3 important links there, guys. The first one's for our 12-month track record. Second one is, of course, we have lots of information posted on our blog, different articles, video series there, and then, of course, the third one is for our 3-week trial. Track record, trial, and our blog. Guys, if you haven't checked those links out, please use those links in the description of the video. Let's see, 2, 4, 5 total trades today, guys. We had one small loss, one larger winner there, a bunch of little small wins there. We had non-farm payrolls come out tomorrow. Yesterday was a quiet day. We did, as you can see here, five trades, guys, 49 ticks out of the market today, 490. That brings us $21,500 for the year and $2,000 for the week here in the first week of March. We'll keep you guys posted as we make it the month of March. Now, what was the most important thing that happened today? Let's see, what was the most valuable thing we learned today? Well, we had a slow day yesterday. Yeah, yesterday was like watching paint dry. We have non-farm payrolls tomorrow, right? The NFP announcement, of course, hourly earnings, unemployment rate, employment situation, big time news event tomorrow. So we knew tomorrow's Friday, end of the week, non-farm payrolls come on Friday. And then we've got, of course, yesterday was very slow, so we thought today had potential to be very slow as well. Now, when we know going into the day that today is going to be potentially a very slow and choppy market this morning, what can we use to be that filter to tell us when the market is really going to be able to be moving? Well, it's the dollar. We like looking at the dollar index, the DX, dollar index futures. And we look at the dollar, we open up our slow time frame and our fast time frame, just like we do on gold and crude and the euro and everything else we trade, guys. We use multiple time frames. Now, when I open up my slow time from the dollar this morning, we look for major levels of support and resistance, right? Double tops, double bottoms, high of day, low of day. Then we look at the pace of a tape indicator in the dollar, and that tells us how fast the dollar is moving, right? Fast or slow. Then we open up our short-term, right? Our short-term trend on the fast time frame to look for that trending environment. Okay, so slow time frame, looking for major support and resistance. My fast time frame, I looked for the short-term trend, right? Are we trending up? Are we trending down? And I want to be aware, right? Avoid trading when the dollar on the short term has choppy, sloppy, sideways markets. And then don't forget to watch the pace of a tape indicator on your dollar. The pace of a tape indicator will tell you how fast the dollar is moving. So on a day like this morning, when we knew today was going to be a little bit slow, we looked for the dollar to kind of give us that green light when the dollar was moving quickly, when the dollar was trending, or when the dollar, of course, was not doing those. We knew to stay away. So we had a great idea today as far as what we expected to see, and then we used the dollar index as a great filter for when our trade pattern is set up. We'd look at the dollar. If the dollar was moving quickly, if it was trending, if it didn't have anything its way, we would then take the trade on the crude, the gold, the euro, whatever it is. All right, guys, that's one easy thing we did today, guys, and a great valuable lesson today of how when we have a slow day, what else to be looking at to tell us when those slow days are going to give us those windows of opportunity to take some trades. Now, we saw this happen a couple times today. I want to make sure we continue to remind you guys, the momentum indicator we use is a very easy indicator to learn, right? For a long trade, you want to point it up. For a short trade, you want to point it down. But it can throw us curveballs because you can see, guys, right now, on the right side of the screen, you're going to see a setup here for a breaker pattern short. Okay, so on the right side here, you can see we have the setup here for the breaker short, right? We're looking to break below the swing low here. Well, when we look down here, though, lower left here, we see we got the pace of a tape indicator had dropped to red. Okay, see that dropped to red. And then we see the momentum indicator over here, right? Momentum, of course, look at that. Very sideways. You can see this kind of jagged look, right, to this momentum indicator. Remember, guys, we want momentum to be nice and smooth, right? Curling up from the bottom for a long trade, pointing down from the top for a short trade. This momentum indicator here, guys, is not smooth. You can see it's kind of chopping back and forth inside of that momentum indicator at the bottom of the chart. Now, what we're waiting for here is, for a breaker short, we're waiting for momentum to point down and have some big sellers over here. Right? Now, we saw a bunch of big sellers here, but momentum continued to give us those head fakes. And that was something we saw yesterday. It was something we saw this morning. And so we really wanted to be patient to make sure the momentum indicator for a short trade was really pointing down and not just oversold and getting ready to curl back up. All right, guys? So let's take a look at some of the trades we took today. But that's a great example of momentum we want to avoid today. Now the first trade here was on crude at 9:12, so just before that 9:15 alarm goes off for our 9:30 open. We have the short-term trend is down. You can tell my short-term trend by the slope of my trigger line. We then have this red line here, right? That red line is support. We break below that red line, of course, and there's your swing low. We break below that swing low for your breaker pattern short. 9:12 was the time. It was a breaker pattern short. 80.23 was the fill. We got filled at +4, first target. Move our stop down to entry -1. We got a lucky bounce there, got entry +2. So, of course, that's 12 ticks total. 2 off at 4, 2 off at 2. 12 ticks total, or 120 USD. So the first trade of the morning, guys, just before 9:15 at 9:12 here, put 12 ticks in our pocket, 120 USD, and a very simple breaker pattern to the downside. All right, let's keep moving. As you can see, guys, the first 4 trades of the morning here were all on crude. Now, next up, about a half an hour later, we had to wait to get through the 9:30 open, and we then, of course, now looking for another breaker pattern here. We know it's a breaker pattern by looking at the slope of that trigger line, right? Coming down, slope is pointing down here. We have the red line here, that red line here at 80.50, 80.51. We break below that red line, mark up our swing low, and there's your breaker pattern short. And you can see it get very choppy down here, but not until after we'd already grabbed +5, and +2. Now, this is a 3-strike rule. What is the 3-strike rule? 3-strike rule says if my target is tested 1, 2, 3 times but not filled, I'll then force that target filled. The second target was the one here that didn't get filled. So, of course, that's the second target, the +5 there. We took +4. Of course, we got a lucky bounce there, got +5, and then we saw our second target get tested 1, 2, 3 times. You can see it came right back up here towards our point of entry. We had already gotten that second target filled though at +5. I forced that target filled because of the 3-strike rule, and then of course we got bounced out at entry +2, 17 ticks or 170 USD. So again, the 3-strike rule in this is what was a difference between taking 5 ticks out of the market and of course taking 2 ticks out of the market. So that 3-strike rule basically says if we don't get that target filled, we need to force it filled. All right, guys.